Did you know that in some years, the wealthiest people in America have paid a lower effective tax rate than the average nurse, teacher, or firefighter? It's a fact that can be hard to believe, especially when tax season comes around for the rest of us. So how is this possible? How do billionaires legally end up with a tax bill that can be smaller than yours? It's not about stuffing cash in offshore accounts like in the movies. It's a sophisticated and perfectly legal strategy built directly into the US tax code, a system they've learned to master. At the heart of this strategy is a simple three-step mantra: buy, borrow, die. It starts with buying. Imagine a billionaire investor acquiring millions of dollars in assets. This could be company stocks, a portfolio of prime real estate, or a collection of priceless art. As the value of these assets skyrockets, his net worth explodes. But here's the crucial part. As long as he doesn't sell, these are considered unrealized gains. According to the tax code, you only pay capital gains tax when you sell an asset for a profit. So, on paper, this billionaire could be getting hundreds of millions richer. Yet he generates no taxable income from this wealth. Next comes the borrowing phase. A tech founder with a massive, appreciated stock portfolio needs cash to fund his lavish lifestyle, from yachts to private jets. Instead of selling his stock and triggering a huge tax bill, he simply goes to a bank. He uses his multi-billion-dollar portfolio as collateral to take out a massive loan at a very low interest rate. For the bank, it's a risk-free deal. For the founder, it's a brilliant move. Loans are not considered income, so this river of cash flows to him completely tax-free. He can live like a king for years, all while his original assets continue to grow in value. The final step is perhaps the most powerful: die. When our wealthy individual passes away, he leaves his vast fortune to his heirs. This is where a loophole called the stepped-up basis comes into play. All of those assets, the stocks, the real estate, the art, are revalued to their market price on the date of death. It's as if the heir just purchased them for their current, much higher price. This single move legally erases decades of capital gains from the tax record. The heir can then sell these assets immediately and pay little to no capital gains tax, securing the family's wealth for another generation. Beyond this core strategy, other powerful tools are at their disposal. Philanthropy, for instance, is not just about generosity. It's a strategic financial move. A billionaire can donate appreciated stock directly to a charity. By doing so, they get to deduct the full market value of the stock from their taxes, all while permanently avoiding the capital gains tax they would have paid if they'd sold it. Another key method involves pass-through businesses. By structuring their companies as S-corporations or partnerships, profits pass through directly to the owner's personal income statements. This allows them to avoid the corporate income tax and instead be taxed at individual rates, which can be lower and offer more deductions. From the elegant cycle of buy, borrow, die to strategic giving and clever business structures, the system is filled with pathways that allow wealth to be shielded from taxation. These methods are not secret, nor are they illegal. They are written into the very fabric of the tax code. It raises a fundamental question about the nature of our financial system. Is it designed to tax work and wages, or is it designed to protect and grow capital? The answer has profound implications for how wealth is accumulated, preserved, and passed down, shaping the economic landscape for everyone.